This conference will now be recorded.
Welcome to our quarterly update call for the second quarter of 2019. First, a disclaimer. Any information provided in our biographies regarding companies or industries named is not a complete summary or statement of all available data necessary for making an investment decision. It is for information purposes only and does not constitute a recommendation. Raymond James is not affiliated with and does not endorse the opinions or services of independent third-party organizations.
Good morning. This is Stephanie Roberts, and I'm here with my brother, Brandon Hayes. To get started, first I'd like to share some exciting news for our team. Brandon was recently selected to become a member of the Institute of Investment Management Consulting at Raymond James. The Institute was developed to help financial advisors drive success in their consulting practices through educational programs, ongoing communication forums, and networking with other financial advisors. The IIMC curriculum provides these advisors with advanced knowledge and concepts commensurate with many high-level institutional money management consultants. IIMC members are selected based on their demonstrated commitment to pursuing a consulting approach in managing and growing their practices. Congratulations, Brandon.
Thank you.
We also have some great news about Steward Partners, which continues to grow and to strengthen its advisor team. We now have 20 offices, including our newest in Hendersonville, North Carolina, and Plymouth Meeting, Pennsylvania. Our 209 partners are managing or advising on over $12 billion.
And now we'd like to introduce our special guest this morning. Corey Hardy is a portfolio specialist at ClearBridge, an independent third-party provider. Corey joined ClearBridge in 2014 and has 8 years of investment industry experience. As an investment specialist, Corey provides capital markets and economic analysis, as well as portfolio construction and fundamental equity research insights to audiences ranging from broker-dealers, financial advisors, institutional clients, and investment consultants. Prior to joining ClearBridge, he was a client service specialist at Atlanta Sosnoff Capital. He received a BS in Business Administration from the Gabelli School of Business at Fordham University with a concentration in finance.
Great. Thank you very much for the introduction. My name, again, is Corey Hardy, and today I'm going to be going over the Anatomy of a Recession presentation, or a shortened version of that presentation. The original version is about 60 slides long, so we have mercifully used the shorter version. My comments are going to be about 15 to 20 minutes, and then we're going to stop there. But this presentation really is unique in that it's designed to be both informative and instructive. So many of these presentations are designed just to be informative, while this one is designed to really give you some insight as to how you should be thinking about the stock market and the economy at this juncture. So today, the market's up year-to-date roughly 20%. We're around all-time highs. I think right now is a great time to be talking about how to differentiate noise from signal. So we know what the noise is, right? Everyone every day goes home, turns on the news, and you see Jim Cramer telling you to buy, or sell. We jokingly refer to this as the Jim Cramerization of America. It is a terrible way to get insight as to what you should be doing with your allocation, your equity exposure. So instead, what we're trying to do is direct you toward the genuine signal, the thing you should be looking at, and avoid all that noise. So in our opinion, flipping to slide 2 of the presentation, what we're looking at as our genuine signal are economic recession. The reason we've chosen economic recessions as the signal you should look for is because economic recessions and big market crashes tend to coincide with one another. So economic recessions are commonly defined as 2 negative quarters of GDP growth, consecutive quarters of negative GDP growth. But funny enough, there is no textbook definition for what constitutes a market crash. So by our definition, on this slide, the way we've defined market crashes are 20% drawdowns or more that last longer than 1 year for the S&P 500. And by that definition, since the early 60s, you've seen about 6 of these market crashes. And 5 of those market crashes have coincided with economic recessions. Compare that to more garden variety pullbacks. These are pullbacks of 15% or more that do not meet the magnitude or duration requirements to constitute a market crash. We've had about 7 of those. Most recently was September to December of last year, where the market was down about 19%. I'm sure all of you still feel the sting of that big dramatic pull down. But the important part, and again, to bring this home, why we're viewing these economic recessions as our signal is because these market crashes, those are the things you live in fear of as investors. So these market crashes on average have erased about 42% of your capital, which is about 2.3 times more severe as one of those garden variety pullbacks. They tend to be about 3.7 times longer than the average pullback. And most importantly, again, why we're choosing the recession as our signal, these market crashes are close to 3 times more likely to coincide with an actual economic recession. So if you can tell when an economic recession is on the horizon, you can avoid those big market drawdowns of 42% on average. So the next logical question is, what are some of the things you need to be looking at in order to avoid the pain of one of these big market crashes and know when an economic recession is on the horizon? So one of the things we look at, or we hear from clients all the time that we should be looking at, is the length of the economic expansion. So flipping to slide 3, what we're trying to do on this slide is put in the context the length of this expansion. So a lot of folks intuitively believe that because this has now officially been the longest economic expansion in U.S. history, the end has got to be near. So the music's got to stop soon. And while that does make a ton of sense intuitively, logically, and when you look at the actual data, it doesn't hold water. So looking at slide 3, what you're looking at on that slide is every single economic expansion going back to 1948. Each one of those lines represents an economic expansion, and that blue line on the bottom is our current economic expansion. And what you can see from this slide is that even though this has been the longest economic expansion in U.S. history, in terms of cumulative GDP growth or cumulative economic growth from the prior peak in the economy, we're still not even past the average in terms of growth. So we're at about 20% cumulative growth from the prior peak, and the average is about 23%. So put very simply, the most simplistic way to think about this slide is no boom, no bust. We haven't seen that big boom in actual economic activity that usually leads to an overheating in some form of the economy. So we're not afraid of that corresponding bust of a recession on the other side. So just based on time alone here domestically, we're not super worried. But that's just looking at it from a domestic context. Looking at it from a more of a global context on slide 4, you're looking again, the U.S., our present one is on top in blue, and then you see several other elongated growth cycles from around the world. The most notable ones are on the bottom, which are Australia and Japan. Japan went through a 17-year economic lasted until 1992. And Australia currently today is in the midst of a 28-year economic expansion, which is pretty amazing. And what are the things that make these long cycles possible? Slow, low growth, which is exactly what we've seen here today in our economy. You have increased financial regulations from the prior economic recession, which is what we've seen in the economy. And then lastly, you have a super flat Phillips curve, which is a very nerdy way to say that you have you have very low inflation and a very tight labor market. So even though you have a really tight labor market where jobs are easy to come by, inflation is still quite depressed. All three of those things lead to a very elongated cycle. So for that, just based on time alone, we spent 2 slides talking about that one data point, which is time. And just looking at that one data point, we're not ultra concerned about the state of the U.S. economy. So again, we just spent a little bit of time talking about that one data point, which is time. And I mentioned at the outset of the call that part of this presentation is really designed to help you fight what we call that Jim Cramerization of America, where people want to take a day trading mentality to their long-term investments. And that can be a hugely capital destructive behavior. So the big part of this presentation is over the next 3 slides. And this is the thing I really want folks to walk away with, is instead of looking at one data point like we just did, it's really much more helpful to look at multiple data points and their historical impact on the economy. And with this in mind, flipping to slide 5, ClearBridge has created this U.S. Recession Risk Indicator dashboard of 12 separate individual economic indicators designed to give you some lead time on when stress is building on the horizon in the economy. So these are 12 forward-looking leading economic indicators that should give you a signal when that stress is building. These 12 indicators are based on the 4 fault lines of the U.S. economy. So you have business activity, you have consumer, you have inflationary pressures, and then you have financial stresses. All 4 of these and all these 12 indicators have historically done an awesome job of giving you that signal when that stress is building. Today, these 12 indicators are signaling that there are some stresses starting to build in the economy. So it's a bit of a sobering thought, but this is the first time since we've been running these indicators live where the overall signal has now actually shifted from green, which would be all good, to yellow, which is signaling that there is some caution building on the horizon. So as it stands right now, we have 4 indicators that look yellow. And for those of you who may not have this presentation in front of you, these indicators are built to just show you a simple stoplight analogy. So each indicator has an individual color next to it. So red would mean that this individual indicator is showing you that a recession is imminent. Yellow would mean it's showing you that there's caution of a recession on the horizon. And green would mean, based on this individual indicator, there's no worries that a recession is looming soon. So as it stands right now, we have 6 green indicators, 2 red indicators, and 4 yellow. So this overall signal now, so these are not equally weighted. There's a lot of really nerdy quantitative research that goes in on the back end of this. We've tried to present this in the most simplistic way possible, but the overall signal is the thing I really want everyone to key in on. So these 12 indicators are great, but again, the point of this is not to zero in on any one indicator. So to try to avoid that, I again want to direct everyone's attention to the bottom of this slide 5, to that blue line and the overall signal, which is now yellow. So this yellow signal is signaling to you folks that ClearBridge's probability of recession over the next 12 months is now about 50%. So at this point, we think it's somewhat of a coin flip on whether we see that actual economic recession over the next 12 months. Importantly, the 2 indicators that recently changed in order to cause this to go yellow are both soft economic data points. The 2 indicators that changed are job sentiment and ISM new orders. When I say soft data points, there are 2 different types of economic indicators. There's hard data and soft data. Hard data is quantifiable, calculatable data like a GDP. So it's telling you an actual number that they can calculate based on inflows, outflows, whatever it is. Soft data is something that's based off of surveys. So that's much more indicative of the current state of people's sentiment. So these two indicators just changed from green to yellow. And it really, in our opinion, is reflective of what's going on in terms of the global economy and concerns around trade. So that's a great indicator, but it can be somewhat misleading. So we have an overall signal of yellow, but we will kind of caution that we have seen false yellows in the past. We've had 3 false yellows, and right now we have some historical context to make us feel like it's possible that this one is a false yellow. So again, yellow is designed to say that there's caution on the horizon, but the red signal is really what you want to look for in order to know when you want to get in or out of the stock market or get much more defensive in your equity allocation. Right now, this is just saying, hey, keep an eye out because there's caution building on the horizon. So slide 6 and slide 7 really do a great job of showing you why these 12 indicators, the 12 that we picked. Slide 6 is showing you what these 12 indicators look like going into the last 7 economic recessions. You can see from that slide, we've done an excellent job of being able to predict when that recession is coming. So we've either had a red signal or there's been one yellow signal in the past as those recessions hit. Again, contrast that to today. Usually you have a lot of red signals in the individual indicators, a couple yellow, and virtually no green. Today we've got 6 green, the 4 yellow, and 2 red. So although it's flashing some caution, again, it's just saying that over the next 12 months, there could potentially be a recession. And then slide 7 is showing you that historically, again, these are 12 leading indicators, they give you lead time. So on average, the yellow typically comes about 3 quarters prior to the actual economic recession, but that's the average. Looking at slide 7, you can see that yellow came almost 2 years prior to the actual economic recession. So I would, again, try to caution people not to put too much stock in just this one overall signal. And again, try to think of it in terms of everything else you look at for the market and the economy. But also, the red signal is the thing you need to be looking at. So this is just trying to show you, buckle up. There is some things that are, some cracks that are starting to form at the margin, and we're going to get into some of why that is. but the bedrock of this economy we do think is still quite strong. So I'm not, in the sake of time, going to go through each one of these individual indicators, these 12 indicators, which I'm sure just breaks everyone's heart, but I will go through the yield curve spread in a little bit more detail because that's an important one, and that's a very topical one right now because that yield curve spread did invert quite recently. So on a yield curve spread, what you're looking at is the difference between two yields. So what we look at on slide 8 is the difference between the 10-year Treasury yield and the 3-month T-bill yield. The reason why we look at the difference between those is because it tends to give you some insight when there's going to be weakness in the economy. Because when those two numbers, there's a big differential between those two numbers, there tends to be a lot of liquidity in the system. And when those two numbers shrink and go negative, which they've done recently, it tends to lead to liquidity being pulled out of the system, which can cause economic recession. Historically, this spread, when you see this go negative, it has successfully predicted 7 of the last 7 economic recessions. But as alarming as that might sound, people have the propensity to think of this as the final buzzer at the end of a basketball game. And we have really tried hard to get people to stop thinking about it like that and to start thinking about it like a shot clock. So yes, the shot clock has started, but there's a varying degree of time on that shot clock based on what happens with that yield curve inversion. So how deep the inversion goes and how long it stays inverted really matter in terms of predicting when that economic recession is coming. So historically speaking, and this is based on the Fed's research, not even our proprietary research, historically speaking, this signal is really meaningful when you see that inversion for 3 months and for 50 basis points. As we stand today, this inverted around late May, so not 3 months quite yet, and the deepest it's gotten is just a little bit over 25 basis points. So although we have seen the inversion, which has historically been a pretty scary signal, we haven't seen the magnitude or duration required to make us super nervous that this is going to be the thing that pulls down the economy. So I know I've just gone over a ton of really exciting and fun economic stuff, but I do want to shift gears and try to put into context what all this economic stuff means for the stock market. So flipping to slide 9, you see that the flattening yield curve that we just talked about typically does a good job of signaling that we're going to have more volatility in the stock market over the next 3 years. So long term, the flattening of that yield curve spread that we just spoke about should signal to you, based on slide 9, that volatility in the stock market is going to go up. So that might sound a little scary, but for us, that's a good thing, and I'll get into why in a minute. Another reason why we think volatility might tick up in the stock market is on slide 10, and this has to do with seasonality. So if anybody on the call has ever heard the phrase sell in May and go away as it refers to stocks, that is somewhat true. So looking at slide 10, you'll see that historically speaking, volatility really tends to spike in July, August, and September, and then a little bit in October. So based on the yield curve, we think that volatility is going to go up over the next 3 years based on the sell in May and go away principle, which is, proved out in data on slide 10. Short term, you should expect some more volatility. And last but not least, we expect volatility because of late stage recession concerns. So flipping to slide 11, you'll see that over the last couple years, every time you've seen the market hit new highs, what has brought it back down has been concerns around the tariff situation. So in late 2018, you had the steel and aluminum tariffs that brought the market down. Then in mid 2018, you had the 10% tariff on the $200 billion of Chinese goods that brought the market down. Now we've rallied up pretty significantly, and you've had that 25% on the $200 billion worth of Chinese goods that brought the market down. Now we're back up again. And for us, tariffs are really something that the market has clearly keyed in on. And that's the thing that could potentially derail this great run that we've had in the market recently. Importantly, I know that sounds a little concerning, but for us as active managers, and I alluded to this a moment ago, volatility is a great thing because we can take advantage of that volatility, look for companies that still, even though they might be trading down on any given day based on the market sentiment, they still have solid fundamentals. And by that I mean solid earnings growth, solid revenue growth, solid management, and good stewardship of capital, and we can buy them when everyone else is selling them, and by doing that, create an edge for you guys as our clients. So although this volatility might sound like a scary thing, for us as active managers, that's where we gain our edge. So we're actually quite excited for this uptick in volatility over the short and long term. So we do expect volatility to continue, but switching to the next slide, which is slide 12, this is one of the things that might be a bit of a negative for the market going forward. So the volatility we think is a positive for us, but the one negative is semiconductor trends do point to earnings slowdown globally. So typically, semiconductors lead earnings by about 3 months. And the reason that is because you should think about semiconductors as sort of like the tip of the global economic sphere, because semiconductor sales are really the beginning of the supply chain for most consumer goods. So they're in a lot of stuff. So when semiconductor sales tick down, it does provide a read across for what could be coming in a lot of those consumer goods. So semiconductors going down is something that gives us a little bit of pause about the earnings growth going forward. We have in our longer presentation a slide that does show if we are at peak earnings, it really is not a great reason to get out of the stock market. So I'm not saying we are or not at peak earnings, but if we are, usually historically you have about 3.25 years until that next economic recession, and you have about 40% returns from peak earnings. So even if this slide is showing you that we've hit peak earnings, it doesn't mean that that's the time to pull the ripcord on your equity investments. It just means that it's going to be harder to pick or harder for the broad market to go up. And honestly, again, it does play a little bit more to the active management side. So now that I've kind of given you some of these sobering thoughts on these cracks that might be forming in the bedrock of this global expansion, I do want to switch gears here for a second and talk why, historically speaking, we've seen this before, and it's not making us all that nervous. So again, flipping to slide 13, I think one of the things we talked about was that that overall dashboard of 12 indicators has recently gone yellow. And again, that's concerning, but it has happened in the past where it was a false yellow. And I think looking at slide 13, this does a good job of indicating that there could be a chance that we're going through a potential false yellow on this dashboard. So looking at that 1994 to 1995 example, 1994, we saw a false yellow on our 12 indicators. And 1994 was a strange year because looking at slide 13, you had on the bottom, you had about 4% GDP growth year over year. You had about 19% earnings growth, but for one reason or another, the price to earnings multiple on the stock market contracted by about 3 times. So the market was down 1.5% without dividends that year. So for those of you who aren't familiar with price to earnings multiples, it's basically like a price tag for the stock market. So you're basically saying, I'm willing to pay, if the price to earnings multiple is 18, you're willing to pay $18 for every $1 of earnings that a company has. So it's a way for you to normalize earnings across the market. One of the things that is really interesting about 1994, again, drawing this back to those 12 economic indicators, is looking across those 12 indicators, you really didn't have signs of stress building in the economy. So it was logical to see in 1995 a big, what they call a catch-up trade, where the market really rallied back strong because it had over-discounted something in 1994. So what had happened in 94? There was the Fed had kind of over-tightened and then either paused or cut rates later. This is very similar to what happened last year. So in 2018, looking to the right side of that chart, you had real GDP growth year over year of about 3%, earnings of about 20% year over year, and that price tag or that price to earnings multiple for the stock market contracted by about 3.7 times. So the market was trying to tell you something's really wrong here. But again, drawing from those 12 indicators, the economy wasn't showing any real signs of stress. So we thought this year was probably going to be a significant double-digit year entering 2019. And again, for the first half, we've seen solid returns of about 18.5% through the end of the second quarter. And we've seen that price tag for the stock market go up pretty significantly. So we think that this is similar to the 1994 period where the Fed has probably over-tightened and it's very likely here now that they're going to cut interest rates, and that will create an environment where there's more liquidity in the market, and more liquidity drives markets, which is a good thing for us as equity investors. So we do think that although there are some signs of caution, if we're wrong, the odds of that recession being 50-50, if we're wrong, we do believe it'd be a short and shallow recession, nothing like the 2008 recession, because there's no obvious signs of financial imbalance here. But if we're right, we do think that there's another big leg up in the stock market. So my overall message is stay invested, know what you own, know that you're owning quality, and just keep the course. It's not a reason to get out of the market. In slide 14, it's a really good way to put context on what happens after these big drawdowns that we saw in late 2018. So in late 2018, again, we saw a 19% drawdown. 6 months from that now, we've seen a 25% correction. That is exactly in line with historical averages. And again, drawing from that parallel from slide 13, it's very similar to what we saw in 1984. We do think that the Fed is probably going to pause and ultimately cut rates. And we do think over the next 6 months that we should continue to see upside in the stock market, in line with that historical context of about 30%. Last but not least, one of the reasons we think that is slide 15 and slide 16. Slide 15 is showing you that leverage does not look recessionary. This is a big one because folks tend to look at corporate leverage and think that, wow, corporations have really taken on a lot of debt because of these ultra low interest rates, which is partially true, but it's not super concerning to us because they have termed out a lot of that debt. The weighted average maturity of debt in the S&P 500 is about 10 years. So not ultra concerning to us, but again, it does stand to reason. You got to know what you own and you have to own quality. But from a consumer standpoint, household debt has really come down pretty meaningfully because consumers have deleveraged coming out of 2008. They kind of have burnt fingertips and they're not willing to step out and gain all that leverage that they had at that one point. So non-financial corporate debt and household debt really low. And for that reason, we don't think that we have that big lingering financial crisis type recession on the horizon. And then slide 16, again, is the reason why you should stay invested while knowing what you own. In the final stages of a bull market, you really tend to see incredible returns. So the first year of the final stages of the bull market, or the first year, you tend to see that 38.5% returns. In the middle, you tend to see the 12.7%. And then this is the most important part. Let's just say, for argument's sake, this is the last year, which we don't necessarily believe. But that, in the final year, markets tend to go parabolic. You tend to see about 27% returns in the final year of equity markets. So just because there are some cracks starting to form on the margins, we do not think that it's a reason to get out of the stock market. Again, it's time to start paying more attention to these 12 indicators. If things continue to deteriorate, that would be the time I would say you have to start thinking more and more about getting defensive. But at the moment, know what you own and stay the course. Slide 17 is a really great representation of, we do think that this is a new secular bull market, and we are not anywhere near done with seeing these big outsized returns for the stock market. So I know I've gone over a lot here, and there's a lot, it might be hard to imagine that I haven't covered to this point. In our longer presentation, we have several topics that I'd be happy to address and follow-up questions after this recording is posted. So we can talk about Trump's presidential agenda, earnings, international investments, which we haven't talked about, but we're positive on here at ClearBridge, central bank policy, which we touched on a little bit, volatility, we touched on a little bit, U.S. dollar, debt, and valuations. So if you have questions on any of those topics or anything I did touch on, please feel free to reach out to Stephanie or Brandon, and I'd be happy to follow up with answers on those questions. But that is all the time I had for prepared comments. So I did want to take a second to say thank you, everyone, for listening. Thank you to Stephanie and Brandon. And again, we do think over the next 12 months, the market is on solid footing, albeit with volatility. But don't let that shake you out of the market. And although we're starting to see some cracks form on the economic side, we do think that there is the potential for either for a continued growth in this expansion. And if we're wrong, a short and shallow recession is how we're wrong. So not ultra concerning for us at this point in the market.
Great. Thank you, Corey, and thanks to all of you for your participation today. We welcome your feedback on how we continue to provide value-added services to all of you and help you reach your goals. We look forward to meeting you here again next quarter.